Are cryptocurrencies securities? The Securities and Exchange Commission is answering the question whether we like their answer or not. Cryptocurrency is experiencing unparalleled popularity, with its market cap soaring from $2.3 trillion in 2021 to $2.8 trillion in 2024. This boom has drawn significant regulatory attention, with an executive order from President Biden demanding a closer look at crypto's risks and benefits. Traditionally, cryptocurrencies like Bitcoin have operated outside the regulatory purview of entities like the Securities and Exchange Commission, facilitating rapid transactions among users. However, their independence has also made them prone to volatility, fraud, and a lack of investor protections. The SEC is intensifying its oversight of cryptocurrencies, distinguishing between securities and commodities to ensure proper regulation. Since Bitcoin's inception in 2009, fitting cryptocurrencies into traditional financial categories has been challenging. Former SEC Chair Jay Clayton highlighted that many crypto products likely qualify as securities, necessitating federal registration. He later specified that true cryptocurrencies are commodities, not securities. The classification of digital assets hinges on their function rather than their name, with the Securities and Exchange Commission applying the Howey test to determine if an asset is a security. This test looks for an investment of money in a common enterprise with expectations of profit from others' efforts. The Howey test is a legal criterion established by the United States Supreme Court in 1946 to determine whether a transaction qualifies as an investment contract, thus falling within the scope of securities regulations. The test comprises 4 key elements: 1. An investment of money; 2. In a common enterprise; 3. With an expectation of profits predominantly from the efforts of others; and, number 4. Based on the essential managerial or entrepreneurial efforts of someone other than the investor. If a transaction satisfies all these criteria, it is considered an investment contract and subject to securities laws, irrespective of whether traditional securities like stocks or bonds are involved. The Howey test has become foundational in determining whether certain transactions, including those involving cryptocurrencies and digital assets, should be regulated under securities laws. Current SEC Chair Gary Gensler supports this view, emphasizing that many cryptocurrencies meet the criteria of being securities as defined by the Howey test. Gensler also announced that the SEC would focus on crypto exchanges in 2022, signaling tighter scrutiny ahead. It's no secret that Gensler hates crypto because it is a direct competitor to the American dollar, and he hates how crypto removes government and centralized financial control over our finances. Since then, Gensler and the SEC have gone after 65 different cryptocurrencies to ensure they comply or are removed from American hands. The SEC has successfully pursued legal action against numerous crypto entities, demonstrating its commitment to force their interpretation of the regulation. A notable case involved 𝐾𝐒 Interactive Incorporated, where the SEC deemed 𝐾𝐒's token offering a security, leading to a $5 million penalty. The Securities and Exchange Commission's enforcement isn't limited to issuers, but extends to platforms like BlockFi, which was penalized for not registering its interest accounts as securities. BlockFi's settlement with the Securities and Exchange Commission and a subsequent class action lawsuit underscore the legal challenges facing crypto lending platforms. A significant lawsuit against Ripple Labs Incorporated for an unregistered securities offering of XRP highlights the ongoing debate around cryptocurrency regulation. Yet, in October of 2023, the U.S. Securities and Exchange Commission dropped claims against 2 Ripple Labs executives in its lawsuit alleging the blockchain company violated U.S. securities law. In its December 2020 lawsuit, the SEC accused Ripple of illegally raising more than $1.3 billion in an unregistered securities offering by selling XRP. U.S. District Judge Annalisa Torres in Manhattan granted Ripple a partial win in the case in July, finding that sales of XRP on public exchanges were not unregistered securities offerings. Torres subsequently rejected a request by the SEC to appeal that ruling. U.S. District Judge Annalisa Torres in Manhattan granted Ripple a partial win in the case in July of 2023, finding that sales of XRP on public exchanges were not unregistered securities offerings. Torres subsequently rejected a request by the SEC to appeal that ruling. Instead of looking for the criminals stealing customer funds on offshore exchanges that were courting political favor, the SEC went after the good guys, Garlinghouse, a Ripple executive, stated. This comment was an apparent reference to Sam Bankman-Fried, founder of crypto exchange FTX. Many hope the outcome of the Ripple case could significantly impact the SEC's future regulatory actions in the crypto space. Yet the truth of the matter is that these results might have further frustrated a desperate beast who is fighting to maintain control of our finances, our families, and America's future. Many financial experts emphasize the importance of understanding the evolving regulatory landscape for cryptocurrencies to navigate potential legal challenges. But it is hard to watch your back when the rules constantly change without warning, regulatory updates are made in secret, or they are created instantaneously to suit a specific situation. Worse, our leaders tell us the legal justification to change the rules simply is, "Because I said so."